Hi, I'm Gregg Wallis, Senior Editor with Hotel Business, and I'm joined today by Mit Shah, CEO of Noble Investment Group. Mit, thanks so much for joining us today.
Gregg, thank you for inviting me.
Great. So, there are a lot of questions out there, but, what are your thoughts on the state of the industry?
Well, I'm generally a pretty optimistic person, and I've said this before, but I think this is also a business that, when you're early in the year, you have to be more optimistic than not. And so I do remain optimistic for a number of different things. I think the long-term trends of how people view travel as an investment in their life, something that creates joy. Earlier today at the conference, you heard Ed Bastian, CEO of the world's largest, travel airline company, talk about that. Like, there's an entire movement around travel for a number of different purposes. And so when you take that and you think about what that means to the broader hotel industry, and room nights, there's 40 million more 25 to 39-year-olds and 55 to 79-year-olds that are coming into the system than existed 10 years ago. And so 40 million more people, and those are the two largest traveling demographics. And so when you think about that, and then you think about how people are prioritizing travel, there's a real secular change in terms of how we look at demand, and that makes me very optimistic.
Can you share some insights into the types of opportunities that Noble is seeing in the current market?
Well, we've actually been very active over the last 2 years. We've invested a little over $2 billion. And I think, if you look at kind of what those opportunities look like, and recognizing that this has been a time where not a lot of transactions take place, I think it's been a combination of debt that needs to get paid down in a rising interest rate environment that we all know. At the same time, you've got renovations that have been delayed significantly post-COVID. I'll give you a little backdrop to that. Post the great financial crisis, renovations and CapEx spending dropped by 40%. Sure. During the pandemic, it was over twice that much that people, didn't invest. And it makes perfect sense because, in those times, you're trying to keep hotels open, you're trying to make payroll, you're trying to do a lot of different things, and the lenders and the brands were very, flexible in terms of saying, hey, use this liquidity to keep and protect the asset. So now here we are in 2024, 4 years beyond that, when you have a substantial amount of inventory that hasn't been touched. And let's not assume that everything was renovated in 2019, right? So we know that, and if I go back to the great financial crisis, our best investment years were in 2013 and 2014, 5 and 6 years after Lehman failed. And so if you kind of look forward into the opportunity set, I think it's people like to use the word distress. I think it's really a combination of a variety of different stress points. And those two are two really big stress points. Here's the third one. In our space, predominantly select service and extended stay, a lot of these companies were formed in the 1990s by people who were at that time perhaps in their 40s. Sure. So now just advance the clock a little bit, and we can all do the math and realize that these are leaders that are at a different stage of their lives, and going through another cycle isn't really the thing that they think about, wanting to prioritize going forward. So we've actually had a lot of activity and done a lot of investments whereby we have either acquired assets or we've provided new capital into a partnership to allow those that wanted to exit a partnership to exit. And now there's new capital to not only pay down the debt, but to do the renovations. And then we can provide more capital to that ownership and that partnership group to grow their business as we see the trends moving forward.
Great. And, you mentioned both extended stay and the pandemic. And one of the darlings, I guess you could say, during the pandemic was extended stay. What makes that sector, especially the midscale portion of it, so compelling?
Well, I think it's a few things, and it's not a new segment in the industry, as we all know, right? Okay. And it would surprise a number of people if they thought about, let's just take Residence Inn and Homewood Suites and maybe Home2 and and some others, and what's the average length of stay? It's really 3 to 4 nights. And that doesn't feel like extended stay to a lot of folks, right? It just seems like, hey, maybe it's a few longer term stay, but people really do value the opportunity to stay for long periods and durations at a place that's fully furnished, that has cable and utilities and all the things that you would want. And there's essentially a customer group that is growing, that is looking for a place for 30-plus night stays. And whether that's 30 days, whether that's 3 months, 6 months, or even upwards to a year. And those customers have been staying at these different brands for quite some period of time.
Right.
And we think that that's really interesting, because if you go back to the mid-scale extended stay part of your question, during 2020, the performance was really on top of what 2019 was.
Mm-hmm.
I mean, it's staggering to see, because people are living there, and I think this is really where our industry is going to continue to move. And you've heard from the largest brands in our business that essentially what they want to do is they want to own that customer in every part of their life cycle. So whether it is they are traveling and they stay in a hotel, to whether they are wanting to get on a cruise, to whether they want to go to their favorite sporting event, to whatever, all of those things combined. You see, Apartments by Bonvoy, which is in the living space. Margaritaville has done an amazing job of creating communities where there's a hub of hospitality, and school teachers from the Midwest, that is where they go and retire, and they own a home. And so, I think what's happening in our space that is important to pay attention to is that we've gone from the hotel business to really the travel and the living business.
Sure.
And so mid-scale extended stay, we view, is really a nexus between hospitality, between multifamily, and a little bit of workforce housing. And so when you combine all those with the longer duration stays, 30-plus nights, you can operate these assets with less than 10 full-time employees, because you're running them more like apartments than you are in hotels. And so we like the durability of the demand and the performance. We like the efficiency of the operation, and that ultimately delivers cash flow, to investments. So, this isn't, by the way, this isn't like a new industry class that all of a sudden we're looking at, because it's been around for a long time.
Definitely.
What is new is that we have some of the leading brands introducing product. Mm-hmm. And I think we also know this: new will more often than not beat old. And it's not just because it's newer and fresher. It's the rooms, fit the current traveler. The fitness, whatever offering is in keeping with what that customer is looking for, or the laundry and the like. And we see this in a number of different asset classes, like cold storage. Cold storage has been around for a long time, but now how we transport those kind of products have morphed and changed, or self-storage, or even student housing and the like. So I think this new kind of product with a customer set that has been in existence and is growing substantially because of the mobility of work and travel, it's an exciting place in which to be, which is no surprise why these new brand offerings have been introduced.
Well, Mit, thank you so much for joining us today. I really appreciate it.
A real pleasure. Thank you so much.
Thank you.